Good evening, traders. This is Francesco from FreeFX. It has been a few days. I've been quite busy and life is starting to return to normal after COVID-19 lockdown, with my daughter being at nursery back this and last week. I've taken the opportunity to kind of catch up on a few things which I hadn't been able to. So apologies if I haven't posted any videos, but I'm back with a lot has been happening in my trading. So today's topic, first of all, disclaimer, but today's topic is quite an interesting one. Today's topic is to do with gold. So I'm going to talk about gold because that's been kind of something of interest to me personally, and I'll explain why. So essentially, the topic of the day is exhausting. A little pun there on XAU. It's the 3 letters for gold, and it's exhausting trading gold. Why? Because gold trading in the third quarter of 2020 has been, well, actually second quarter and third quarter, but especially now, it's been quite a tricky place to be. I'll explain why in terms of levels and what to do with gold as a commodity. So I'm going to just skip this saving palaver on Word and go on to the important stuff. So first chart of the session, side to think about gold. Essentially, we have a situation where, so gold essentially is something that I've been looking at recently because my parents who invested in my trading recently and whose capital I've doubled. I've sort of been having a conversation with them for some time about what they thought about gold, because they were asking me about gold. And obviously different ways to get gold. So you can obviously buy the physical commodity yourself from a dealer, or buy through a dealer via a bank, or basically invest in ETFs or kind of trade it yourself speculatively as a contract for difference. So essentially as a commodity on a trading platform. So given all that, I started really looking into it because of that. I previously looked at gold and always found it a bit scary because it's a bit expensive to trade, and it just seems a bit unpredictable. You know, one day you hear reports of gold being a safe trade, the next day the safe trade, the safe haven trade is over, and everybody's kind of rushing out of gold. So I never quite understood the logic of trading gold either intraday, which is quite expensive, or on a longer term because it's kind of a bit unpredictable at times. So I was thinking about the situation with gold and sort of how it's priced and what is the right price to buy gold at in this kind of scenario of but really just for my parents. As I said, we talked about gold before, and we looked into kind of dealers, how it works, you know, who's registered and who's authorized, was a genuine dealer, how the structure of buying gold, you know, by troy ounce, how small a quantity you can buy for how much, all these things. We kind of looked into that before, and but we're kind of thinking about it again and sort of looking from a trading stroke investing point of view. And as it happens, obviously gold has been on news, so my parents again were asking me, you know, what should we do? And I said, well, ask, you know, at the bank and see how they offer it and kind of what way you can purchase it. And the person at the bank again sort of said what I kind of said, which is kind of, it was a bit overpriced gold at the moment. Maybe to wait for it to come down a bit to make it more worthwhile. And then I started looking at charts. So in blue here, you see that the August 2011, so exactly 9 years ago, almost to the day, gold touched the level that we're at exactly now. At the end of today, as I speak, gold has climbed down to 1,921, you know, almost to the penny, or to the cent, I should say. And basically that means that we are now in a situation where we've gone past the 2,000 mark. It's displayed in percentages here, but for a reason, because when I compare different sort of prices, if I do buy actual price. Some of these lines were flattened, so I have to do it by percentages. But so 2000 be about here, just where I'm pointing there. So 1921 is a big red line rather than the 2000, because 2000 is like a number plucked in the air. It's a kind of psychological round number. Yes, important, but the important one at the moment is this one, because this is the highest that we had for 9 years, and we're back on it, having been over it, reached a top, and after this top we come back down. So now that we're sitting on that, the question is, are we going to basically take that as a new rally point, and gold is going to go higher to, or even higher highs, sort of all-time historic highs, or is it going to retrace and come back down this and sort of repeat this cycle of depreciation by about 70%, and so be it. But actually we don't know that, so that's why it's quite important at the moment to think about what's going to happen in the next few days. I will come back to this chart because there are a few lines that you can see which are kind of relevant to my discussion. So, and the general trend is obviously on the upside, and I say that because this chart here, this is from fxtop.com, which is a great site. Got in touch with the owner before. Very useful site and free, as you can see. And what it gives is historic charts going back decades, and I think it's one of the most wonderful things. You can get broker platforms that will tell you, for a few years, but then it kind of stops. With this, you can go back and all the way to the start of the New Zealand dollar. After it switched from the New Zealand pound, you can go back decades. You can go back to before the formation of the European currency, a single currency, and still get a sort of exchange rate, euro to dollar, which obviously is not based on the single currency, but on the kind of combined euro area, European area exchange, maybe based on the Deutschmark or something, but essentially gives you a sense of trend through history, even before a formation of a particular currency, but maybe the most influential currency in Europe. And for this particular chart I didn't make particular sense there, but I was trying to tell you that you might sort of object to the way that this is linear through time on gold, when maybe gold dollar traded like this wasn't quite as we have it now. But essentially I'm not sure by what means, but it gives you a historic kind of trend anyway. So without questioning too much the data source for every single kind of year, you can see, for example, I put it down to the maximum data available from 1953. And you can see almost like a flat line there until 1968, which is there, and it starts kind of rising a little bit. And you can start kind of asking about that and say, well, how did you get to this kind of flat line here? What happened before 1953? Wasn't gold in existence? Yes, it was. Wasn't it priced maybe in US dollars? Maybe yes, but again, I don't know the ifs and buts and wherewithals. But I would say that the important thing here is that when you follow this this trend, you see that from the early 2000s here, we've basically been climbing steadily all the way. Obviously, if you're looking at this, it's 20 years. Obviously, it's steady within a 20-year trend, but obviously within that there are big swings. But overall, it's been trading steadily up and trending up to this 2011 top that I described, which is 9 years ago. And I would just surpass that and come back to it. So from essentially 2000 to 2011, it's been kind of steadily really appreciating and going over this peak here in 1980. A little history here. So the overall trend is up. A little bit of history here. You can trace back things in gold that happened. So 1976, and this is more about the dollar, but the dollar was decoupled from gold. The gold standard was declared dead. essentially by Nixon, and not just Nixon, obviously, but that was the decision. And so the gold standard was no longer tied to US dollar, and then essentially other currencies followed. But essentially, 1976 is a very important date. Something happened in 1979 called the essentially the oil crisis, the energy crisis, and there was the Iranian Revolution. So the oil sort of went into huge swings, and then gold, as a result, appreciated massively. As you can see, the spike here, quite a natural spike. This created a recession and so on. So the safe trade, the safe haven, safety trade was on, and then it depreciated almost like all the way to where it came back from previous levels, all the way from the top. So these spikes are great when you think about a safe trade, but they're not a great investment if you think about it. If you're thinking of 5-year cycle, 79 to 84, that's 84. You basically lost all value unless you sold within those 5 years. So it's not exactly an investment. Whereas from 2000, you can see here this appreciation. Now that if you bought, around these parts, even sort of in the middle of that, you'd have got your money back and more. So the trend is indeed up. What's also significant about this trend going from the 1950s is that if you look at the website for the Authority on Gold, which is the World Gold Council, they'll basically tell you that most of the gold has been, this is actually a graph that shows you gold supply in percentages. So 10-year average from 2008 to 17, 52% of gold supply is jewelry. Okay. So, and then you've got bar and coin, 27%, technology. ETFs actually only account for 3%, financial products. So still the physical gold used to produce jewelry is a massive amount. And then storage, coin and bars, 27%, also a really important, significant kind of amount. 67% of those 10 years was mined gold, and recycle was 33%. So the other thing about this, going back to mining, is that gold has been supplied or mined steadily, kind of on an average, on a similar kind of percentage every year for years now. It's been quite steady. So there's been more gold in circulation, but the kind of mining is because there's a kind of conservative way of looking at stocks, mining stocks. So the underground gold of a gold mine, it's not mined immediately. There's a time where it has to be economically viable to mine gold because of the extraction, the cost of that, and the refining of that versus the price of gold on the market. So there is an interplay between supply and the actual speculative price of gold, and I'll come back to that. But what's important is that essentially, if you look at gold supply, there's a part here, which is that we have, I think it said in one of the pages, which I can't quite find at the moment, that from of sort of in the history of gold extraction that is recorded, 2/3 of that has happened from 1950 to the present day. So that's obviously almost, well, 2/3 of century, or 3/4 of a century. But if you look back to this chart, you can see that from the 50s, that's quite flat, but let's say from the 70s, there's been a steady increase of supply, and price has increased. So you have to think that if that supply continues to be supplied and to be extracted steadily, it is likely that gold will continue to increase just take it as a theoretical point of view. Obviously, trading it and the speculative side are different, but think about that for a moment, an implication of the trend, which as you can see has been on the upside, except this 9-year period where it's basically gone backwards on itself as a V shape. All right, so I'll close this chart because I think I've made my point. I'll return to this from 2011 to 2020, where XAU/USD, so our USD gold, has kind of returned back on itself. And then I started thinking, well, okay, so we've got the supply side, and who is actually supplying gold? And I started looking at the largest companies or corporations that actually are responsible for mining gold and also have auxiliary companies that deal with gold trading. Okay, so I went to a website, looked up, and this is dated 21st of July 2020. So Melissa Pistilli has written an article, and she says in this article that the top 10 companies as they stand at the moment are the following. The top 2 are Newmont, who's an American company, and Barrick Gold. And Newmont has produced about 200 tons and Barrick Gold 170. And then I went to find the charts for them. So Newmont is this one in red, and Barrick Gold is this one. Okay, in orange. Okay, visually, if we look at the last period from for the last year, basically from August last year, you can see very clearly the streamlining of the three, gold and these last two, which are the largest producers, two of the top producers of gold or mining companies. Price responding very sharply. See that at the COVID point here, March, this drop that affected so much of financials, from S&P 500, indices, metals, everything. And then the response back up, gold, mining companies, etc. Yeah. What is significant about these charts, though, is that whereas gold has just returned to that 2011 high just now, these are the companies. So Newmont has actually, well, if you look at, Newmont has actually returned to previous levels as well. But Barrick has actually depreciated quite a bit, so it hasn't really returned to its previous levels. And just to prove that to you, I'm just going to move the chart a little bit, because sometimes moving the charts kind of, when you've got comparisons between different data, they jiggle about like this a bit. But you can see that doesn't change things. So not all mining companies are created equal. And there is also another thing, which is that if you look at the history of Newmont, which I had looked at. I'm just going to do that. Okay, so I'm going to just squeeze things here. So that's from the 1990s. Okay. Look at the trajectory. As I said, from 2000, gold has just gone sky high, yeah, until 2011. And with the other two companies, okay, you've got your red here, which is back to 2011 kind of levels. Yeah, roughly. And with Barrick, we're not back to those levels, okay? But what's significant as well is that with Newmont, we were roughly around these levels in 2006. So gold has kind of speculatively risen quite a lot more than the value of the largest company presently, which has been around for quite some time through different mergers and acquisitions and restructurings. But still, the company, as it stands at the moment, is the largest company. its stock market value has not essentially progressed much in 14 years. So there's definitely something going on there. And what some people have been saying that about certain, taking some mining companies as an example, not these two in particular, but others, is that whereas gold has been appreciating, 20%, 40%, etc., these companies have been struggling to make equally large gains. And this to them is almost like an RSI overbought divergence kind of signal, signifying that gold is in for a correction. And indeed, if you like your indicators, I'm going to just delete a few things here. If you like your indicators, you can take these out and start doing something like this, where I basically say, all right, okay, so we're not too happy about that, fine. So let's compare, go back to your daily, let's compare the current price to an RSI kind of structure, and for that, we'll put an RSI. So let's put in an RSI and say, okay, I'm going to give it a particular setup of 80 to 20. We'll change that because I prefer the 80-20 than the 70-30. And then once we got that in place, we can see how overbought we are. All right, so let's put that as a red and the other one as a red as well. And we can see exactly what is going on with RSI, divergence, and all of that. So that's where we're at. All right, so we go back all the way to 2011 and we start thinking about comparatively how overbought we are with gold. And we say, okay, in 2011, when we got to these highs, where we're at now, we were overbought over 80. But not just then, we were actually overbought from 2010. So for about a year, we had spikes to the overbought territory, and then finally there was a correction. Still overbought here in August 2012, and then the next time we hit 80 and over was actually back in here in February 2016. Although, comparatively it was quite cheaper than 2011, and there's no actual, softening of gold then. And it actually continued higher. There was a divergence, as you can see. That one sort of went lower in a way, and then it corrected lower. The next spike in overbought territory is summer 2019, so a year ago. But it ignored that, continued higher. Another spike here in January of this year, continued higher. Now again, we're in overbought territory, as we are now. Now, this time, it seems that this spike over 80, which has actually lasted a fair bit if you think about it, late July, early August, it now started coming down. So it's actually responded to the idea of overbought, and it might just be, I'm saying that cautiously, that this is possibly a deeper correction, but now we are sort of into the 50 mark. The overbought element has been redressed. So there's scope for a bounce here. Obviously, lots of different possibilities. I'm going to close this actual chart and this one as well. So looking at today, and I apologize for the long video, there's quite a lot to put in there. Looking at today's video, what's interesting about this for the futures side, this is gold futures from CME, Globex, and I've chosen the September, because on the August, this is quite a thin bit of data. We're kind of looking at the September as your quarterly expiry futures contract. So data is much richer here, and you can see that the volume for today was almost equal until about an hour ago. It was exactly the same as the one here on the 30th of July, if I remember correctly. I'm going to put it back to cross so you can see that. So this was the 30th of July, and just put it back in here. Yes, that's right. That was the 30th of July. Let's put it back on view. And so, and this is today. So just compare volume for sell and volume for sell. But look at the candle. Okay, here we've got 1,950 to 1,970. So that 20-point candle okay, and then continuing higher. Look at today's candle, 2025, 1,908. It's over 100 points, not pips, points. That is huge. So this volume, the sell volume for today, has been actually confirmed by a massive sell in the price of gold futures. So this candle has been confirmed and verified by the size of the volume. Has been selling for 3 straight days now. And of course, there's a lot of speculation. This is just people taking profits and off the table. And once people start selling, there's a massive kind of sell rush. And so once that is over, whenever that is, then are there any buyers left? Good question. Let's find out. Okay, for those of you who've been following my videos, you'll be familiar with this by now. It's a CME group open interest on options. Now, I'm not an options expert or trader, not qualified to go into huge details on this. All I do is use this as something like volume at price analysis. So if you had something like TradingView paid subscription, you get that data, which basically is a history, it's a map looking at volume bars for open interest at any particular price up and down the your chart. So this is kind of a number equivalent of that visual. And so all I do is I kind of try to get a sense of how there's a shifting kind of SANS approach to positioning. And if you look at calls, so obviously buy, and you see that, and just a day or two ago, the picture is quite different. What you could see around here was a 2000 and then a 2050, and they were basically the highest number of contract figures, and they were all for buy. So the largest interest was on buying at 2000 for gold and at 2050. A couple of days later, so we're into Wednesday almost, 2000 is actually off the map. And now we've got a range from 1870 to 1990. 1900 buys are the next strongest level at 7091 for calls. And then obviously through different expiry contracts, you see that they kind of decrease. But further down line, there's actually 13,000 plus buy contract for 1900. And at 1950, there's also a fair bit of interest. So now the battle is to regain traction from 1900. And I just spotted something here for 8,000 plus contracts for 1875. So the battle is to get back from the 1900s to 1950s and then back maybe to 2000. So the thinking that we kind of showed earlier, which is from 1921, which is the high of August 2011, is the battleground support, former resistance, now support, to see if there's a continuation of the uptrend that we've seen or not. Okay, so it's very important. And these open interest figures are not a barrier to further selling. It's just what speculative positioning looks like. And indeed, if you were to go onto COT figures through barchart.com, you'd probably find that we'd have something of that, and we could certainly look at that now, but I think we don't particularly want to get into all that. However, if you were to look at that now, you probably find that that was obviously something you want to consider, and you get different speculative positioning for that, and you want to kind of think about where you are if you're positioning yourself. I think possibly we might want to, like look at so look at that. and then see the chart. I haven't actually opened a gold chart before, so on bar chart and a euro, so I'm not sure, and that's it, full chart. If I've got it right here, but I'm looking for the COT, obviously, hoping I've got this right. Like that's just the same as CME is provided by them. Anyway, you get my point. Essentially, I was trying to show you the COT. Right, I found it. So that's basically the COT chart for gold. That's a 3-year term, and you can see the positioning for gold. If you look at the large speculators, it's been steadily declining as gold has been appreciating, or was kind of going a bit flat and then appreciating further. And then, so this point here, back in May, we were kind of declining a bit, and the large speculators were 208,613, and we are about 238. So we've actually added from there. It's been more, and then they got a bit nervous and all that. Looking at the well, there's producers, obviously, kind of the other side. If you're looking at managed money, so the figure is in blue, it's been steadily declining since, again, beginning of the year. We had sort of a high of 238,546, and now we are at essentially 113. So about half of that. So managed money, well, funds, hedge funds, have basically decreased their exposure to gold as price went up. And you got other reportables here in orange. So there's not really a huge gold rush in from that side, which is not what you'd expect when you see the future side and the kind of buying, etc. So there are lots of factors moving gold. It's not always straightforward. And also, let's appreciate that gold is the other side of the US dollar. So we know that the US dollar has depreciated a lot because the euro has appreciated a lot as well, from the 113s to a high of 119, and that's basically been for the European Union and the European Central Bank approving essentially post-pandemic support programs and loans and for European member states, and also because of weakening of the US dollar. So there's always the other side of the coin, which obviously is the US dollar for gold, and then you can go look at the US dollar DXY chart, which obviously is heavily weighted in favor of the euro. So the euro USD price has a huge weight on the DXY index. But even so, you can look at the US dollar and say, well, it's because of the dollar that gold has gone up, etc., etc. But anyway, that's another consideration. This is just another bit of news there from Bloomberg. I'm talking about, the stocks have rallied and investors are basically just steering away from gold now that their confidence is back in the stock market, etc. And that made me think about looking back at the S&P 500. In a previous video, I commented on this strange relationship between S&P 500 and other assets or instruments. So, and if you look at gold, usually gold is sort of the safe haven. It's the to-go place for risky times and risk off. You can see, if I just put it back to 2018, so just kind of just over a couple of years, sorry, you can see that so gold is in red and S&P 500 is in blue, and you can see that they are a mirror version of each other, pretty much, yeah, until we get to COVID-19, and there's this huge drop in February, March, both of them, and then they streamline. So the S&P starts climbing, in the same way as gold starts climbing. Yep, it looks very similar up to this point. So S&P hasn't quite got up to the same level, just missed it by a little bit. And gold has continued to climb higher. So now it's actually come down a little bit, but essentially surpassed the level that it was at in March. So they're not a mirror version of each other. And what we should have seen was this depreciation in the S&P continuing and gold climbing like this. So this should have been a mirror version of gold. Instead, they've both been appreciating. And that, of course, is the confusing picture that we find ourselves in. So to summarize today, investing in gold, two things. One is very expensive to buy gold. So we're looking at a lot more margin to sustain a position in gold than, say, Euro USD. To give you an example, just a very practical example from my demo account, which actually is now, thanks to some gold trades that I've done in the last couple of days, I managed to sell at the right time eventually, because I got it wrong a couple of times, to tell you that. I managed to sell well and made a small fortune. So my account, which I started as a demo in 2019, July, 1st of July, that account is now 207%. But I mostly traded Euro USD, so the gold thing was just because of this, quite fertile ground for trading gold. So yeah, so for example, Euro USD on an FXCM demo, for example, Euro USD opening position of 100K, 100,000. Requires a margin of 3.6K, right? And it gives you a 7.66 per pip value. So 3.6K of margin, 7.6 on a 100K position, right? If I go over to gold, that 7.6 position, 7.6 per pip value is achieved by 1,000 contracts rather than 100,000. 1,000 contract. But 1,000 contracts, it doesn't actually cost you 3.6K of margin. It costs you 85K of margin. Okay. So it's like 25 times. Okay. So it's a lot more expensive. And it doesn't move per pips, it moves per points. So it moves faster and eats your margin faster. So you probably want your per pip value, if your broker quotes metals as FXM does, like it quotes currencies, it quotes per pip, although actually it should quote per point, because it doesn't really move per pip. It jumps a lot of pips. What should happen is that you downsize. You don't look for the same pip value as, say, your USD trade. You downsize. And then you try to have the same margin requirements. So to have the 3.6K, I'd have to have something like 40 contracts. 40 contracts is 3.4K margin, but it only gives you 0.3 per pip value. So it's very expensive and it moves quicker because it's point movements rather than pips. 1 pip is 100th of a point. So if you think about that, how much more you can eat into your margin with gold, it can be quite scary. As we speak, by the way, and I'll finish there, gold has just achieved the price of 1,912. So it's actually broken through the 1,921. However, it's not a huge break. We need to see what tomorrow brings. So I would just encourage sort of caution And these sort of levels are not absolute. They can be elastic by to some degree, by a few points. So just keep it simple, wait, be patient, and if you're going to buy gold for the next leg up, there's plenty of time, and you can really look into that. So I hope this was an instructional video. I'm sorry it's so long. I had so much to say, and I really wanted to get deep into gold and all the different aspects of it. Thank you for listening and watching, and I look forward to seeing you in my next video soon. Thanks.